Alright, hi guys. So welcome to the portfolio review videos. And as always, I divide it into 5 parts. And the first 3 parts, I focus on the capital gains portfolio, which I hold through Interactive Brokers. And my last 2 parts will focus on my dividend portfolio, which I mainly hold through DBS as well as Endowus. So let's begin with the capital gains portfolio. Right now, I've got 47 stocks and ETFs in the portfolio. And for those of you who are new to UIP and new to my investing style, what I mean by a full position is to take 100%, divide by the number of stocks that you have or you plan to have. So for me, I've got 47 stocks. So that means that if I take 100%, divide by 47, my full position would be 2.12%. So what that means is that if I were to decide to add a new stock to the portfolio and I want to build it to a full position, that means I would build it up to 2.12% allocation. Now, of course, some stocks that are more risky, like speculative growth stocks or turnaround stocks, I would only allocate half the normal allocation, which in my case would be about 1%. Yeah. And once I've accumulated a stock to a full position, the discipline is I don't add more. Okay, unless it's a heavenly queen, then I may add a little bit more, but normally I don't. But if it grows organically, that means the share price goes up and the 2% becomes 3, 4, 5, 7%, I don't trim it down. I don't rebalance the portfolio. So I do not do rebalancing. At the same time, if I build a 2% position and the stock price drops, and 2% drops to 1%, for example, I don't add more to bring it back to 2%. So the whole point is I do not rebalance my portfolio. I let it organically grow, the good companies, and the ones that don't do well, they organically shrink away, just like what happens in the index. It will, over time, concentrate itself into the best performing stocks. Okay, so let's run through the 47 stocks. First, I'll show you on my brokerage account, and then I'll show you on my spreadsheet. So you can see I've divided it into categories, and the first category are all the growth stocks, the large growth stocks. And of course, the biggest position is Amazon at 6.85%. This is the percentage allocation. Okay. Second place will be Google, Alphabet at 6.41%. And so on and so forth. And you can see it down here. So my biggest positions, 5 biggest would be Amazon, Alphabet, Palo Alto, Microsoft, and Nvidia at 4.23%. And the rest of them would be, between 1, 2, and 3%, all the way to down here. Yeah. Okay. So next, scrolling down, the next section, these are my predictable businesses. Now again, what does predictable mean? It means it's not high growth. The growth is less than 20%. So these are not high growth stocks, but they have predictable revenue and cash flow. And the first group are predictable and moderately cyclical. So moderately cyclical industries would be like financials, industrials, and consumer discretionary. Yeah. So my biggest position in this category would be Motorola Solutions, 2.48%, MasterCard, 2.34%, Visa, Intercontinental Exchange, and Copart. And then, of course, we've got the rest like Lin, Cintas, AutoZone, MSCI, LVMH, Arch Capital, and Pool Corporation. Then these 3 are my speculative growth stocks and turnaround companies. So these are more risky. I start with a smaller position and just let them grow or die. But yeah, most of them will grow. So biggest is CrowdStrike at 1.12% position. Celsius and Nike. So Nike is a turnaround company. Celsius, CrowdStrike are speculative growth stocks. Next are my defensive stocks. Now, what does defensive mean? Defensive means they are more recession proof because they are in healthcare and on consumer staples. But there are some which are in financials, but they are toll booths such that they are quite recession proof, even though they are under the financial category. So biggest position, HCA Healthcare at 2.34%, S&P Global, United Health, Thermo Fisher, and Waste Management. And the rest like Novo Nordisk, Viva, IDEX, and Mobility Global is a spin-off from S&P Global, right? It's a spin-off company. So in other words, these are so-called free shares that I got. And I'm just holding them until they reach about maybe $25, $30, and then I'll eventually sell it and then merge it back to, reinvest it back to S&P Global. Then are my ETFs. Okay, so ETFs, the biggest position is the semiconductor ETF, of which I've already trimmed about, if I'm not wrong, I trimmed about a quarter or 1/3 already, sold it off at a very, very good high price. And now it dropped, I'm like slowly buying it back. But I won't go that much higher, at the most to 3%. So SOXX, SHLD, the Global X Defense ETF, IHI, Medical Devices, IPO, Defiance, and AI Power Infrastructure, which I've been adding a bit, although it is quite expensive. And China ETF, very small position. And of course, my lone China stock that's still standing is Alibaba, which is just a less than 1% position. All right. So yeah, so that is the portfolio. Now, currently the puts I have, the short put positions, you can see are here. MSCI, 510 put, Nuclear ETF 61 put, MCO, Moody's 450 put, Netflix 72 put, Lin 495 put. This is in the money, and I don't mind being assigned the shares because I want to buy a lot more Lin. But sometimes I'll still roll it down if I think I can end up buying it at a cheaper price. Okay, Pool, which is 260 put. I don't intend to add more Pool until their revenue and profits start to grow again, right? Because right now revenue and profits are declining because of the short-term real estate contraction because of high interest rates. Yeah. Then I've got a few speculative option trades which I shared with you guys, like the EWY bullish synthetic spread, Synopsys Jade Lizard, and the ASML bull put spread. Okay, so there we are. Now I'll show you my Excel sheet over here. And again, you don't actually need an Excel sheet because you can now put it all into Stock Oracle, which I have. So if you go to Stock Oracle, but I didn't update it, by the way, so it's not exactly the same. I haven't updated it because you have to manually update it. If you go to my portfolio over here, yeah, so you can see my positions are here. Yeah, all here. So these are the stocks which I went through. These are all the stocks in my portfolio, which are in Stock Oracle. But again, bear in mind, I have not updated all the quantities. The recent buys, I've not updated it, so it's not exactly the same, right? But I find it useful on Stock Oracle because I can use it to kind of compare across the metrics. Like I said, out of all the 47 stocks, okay, and ETFs, which has the highest projected growth rate in the next 3 to 5 years, I just click on this and can sort by growth projection. So the stock with the highest growth is Palantir, yeah, and Nvidia 43%, Broadcom 38%. So I can sort by growth, I can sort by ROE, I can sort by ROIC, I can sort by 1 year performance. So you can see that this last 12 months, which have been my best performing positions, ASML, SOXX, Palo Alto, Google, United Health, CrowdStrike, these are my best 1 year gains. So this is very useful that you can see on Stock Oracle. And of course, you can see the overall quality of the stocks here under Oracle IQ. Straight away, I can see how healthy my stocks are. Okay, so this one not very healthy because of the real estate contraction because of high interest rates. The rest look pretty healthy. Okay, great. So let's now look at the Excel spreadsheet. So on the Excel spreadsheet, you can see all the 47 stocks are here. Right, and notice I've color coded it. The ones in black are the ETFs, and then I've got my China one, which is in purple. The green ones are the growth stocks, and the red ones are the speculative growth and turnaround. Now, I have not actually updated this. So Palantir, I've now actually put it as a growth stock, no more speculative, because it's kind of like got a track record right now, although not exactly 5 years, right? So it doesn't matter. You can put Palantir under speculative growth or under growth. It doesn't really matter. It's how you want to categorize it. Then I've got all my predictable companies here in orange, and in blue, my defensive stocks. Okay, so what I can show you in addition would be the ones highlighted here. Can you see this golden highlight? These are called my heavenly queens. So heavenly queens are the stocks which I think have got the strongest economic moats and are the most predictable. I call them the heavenly queens. Now, not all of them are high growth. Some of them are high growth, some of them are not high growth, but they are the ones which I think are the most resilient in the long run. So when people say to me, Adam, I'm building a new portfolio, which are the ones I should add first? Okay, I'm not going to buy all 47, right? Maybe I want to only buy 10 or minimum 10. Then I would focus on the heavenly queens. Okay, so my heavenly queens are Meta, Alphabet, Amazon, Microsoft, Nvidia, Apple, Palo Alto, MasterCard, Waste Management, Thermo Fisher, S&P Global. So these are my heavenly queens. Okay. Now, over here, you can see where I intend to add more shares for the rest of the year. At the start of the year, I will have a certain budget of cash from my savings of where I want to add to my portfolio. So I will update this every month. Yeah. So far for this year, I have bought 50% of my planned allocation. So I've got another 50% left to buy for the next 6 months or next 5 months. Okay. So where do I plan to add? I plan to add to here. I plan to add to SHLD, Global X Defense ETF. I plan to add to the AI Power Infrastructure, AIPO. I plan to add to Meta Platforms. Now, for those others which I'm not planning to add, is because I've already added it. I added it early this year, right? Or could be I'm not adding because in the short term, I'm waiting for the certain fundamental elements to stabilize, all right? Like Pool Corporation, for example, or Copart, for example, right? I also plan to add to Apple, plan to add to Netflix, plan to add to MasterCard, Visa, Pool, AutoZone, MSCI. And like I mentioned, Pool is actually very undervalued. It's dropped a lot, but I've not added because I'm waiting to see the fundamentals stabilize. Because short term, the earnings have dropped because of high interest rates and the drop in discretionary pool construction. I plan to add to Lind, and very nice, Lind just dropped after earnings, so very good opportunity for me to add. I always like to buy when there's fear, when there's uncertainty, when people hate the stock. That's when I like to buy it. Cintas want to buy more, but it went up quite a bit already. Arch Capital want to buy more. ICE want to buy more, but all these have already went up a lot. So very hard to buy now. I have to be disciplined and wait for it to drop before I can add. I won't chase it once it's run away. All right. S&P Global, I could still add a bit more. That is still within the buy zone. All right, that's it. So these are all the stocks I plan to add to. Now again, bear in mind that just because I don't add a stock doesn't mean that you cannot add the stock. All right, because like for me, I've got a full position in Microsoft. That's why I'm not adding. I've got a full position in Nvidia. I'm not adding. But if you are someone who doesn't have a position in Nvidia, in Amazon, or Google, my heavenly queens, and you decide that I want to have the heavenly queens, then this could be an opportunity to add as long as the price is below the intrinsic value and has dropped to a support level. And again, I'll cover the support levels and the intrinsic values in the next part. Okay, so now I'm just giving you an overview of the whole portfolio, right? Okay, the other thing I can show you is my breakdown into investment themes. So the long-term investment themes, I divide into 10 main themes, and you can see like companies involved in building the AI CapEx infrastructure like Nvidia, ASML, SOXX. Okay, I've got a 16% allocation to the AI build out. Healthcare, I've got 11% position. emerging markets, which is basically China, 1%. Defense stocks, which is the ETF I own, 2%. Hyperscalers, Microsoft, Meta, Google, and Amazon, 23% allocation. So that's my biggest allocation to hyperscalers. Software companies, software as a service, 7%. Consumer discretionary, 11%. Fintech, 12%. Cybersecurity, 12%. Industrial companies, 4%. So this is not by chance, this is by design. All right, I purposely design it in these percentages. That makes my portfolio very resilient. So if the AI bubble bursts and AI capex stock collapse, my portfolio will still do very well because I'm well covered in a lot of non-AI names as well. Breakdown by investment category, you can see about 7.7% are in ETFs. Predictable companies, 14%. Defensive companies, 14%. Predictable and moderately cyclical, 15%. Turnaround companies, 0.4%, which is Nike, just one stock. Long-term growth companies, 58%. That's the biggest allocation. China stocks, 0.9%, and speculative growth, 3%. So that is how it is allocated. And then next, allocation by sector. So financial sector, 9% allocation. Healthcare, 11.8%. Discretionary, 15.5%. Tech, 40%. Staples, 0.9%. Industrials, 9.2%. Communications, 12.3%. And China, just 0.5%. Okay. So again, all this is not by chance. All this is by design. Begin with the end in mind. Before you buy a stock, for those of you who are beginners, before you buy a stock, you must have a plan what your portfolio will look like at the end of the day. Again, you don't have to own 47 stocks. I'll say minimum at least 10. Minimum 10 stocks. And so make sure they are well diversified across technology, healthcare, financial, so that it's resilient across all different market cycles. That's the whole point. Okay. So in case you want to see, that's about it for that. All right, great. So year to date for the first 7 months, you can see my portfolio is up 17.96%. Now, bear in mind, this is based on as of 14 January, because this is when I started my corporate account. As you guys know, I started the account on 14 January, and on the 23rd or 24th February, then I was able to transfer all my 99% of my shares from my joint account to the corporate account. So that caused a bit of distortion here. Okay, so some of you say, Adam, but can you just show your performance from the time you transferred your shares in? So I have another one, which is this one, which shows you from 24 February, which is the day I transferred my shares from the joint account to the corporate account. That's up 14.48%. So I mean, you can take either one, but to be conservative, I'll take the lower one, which is 14.48% year-to-date performance with 5 more months to go. So for last month, my biggest contributors to my gain of the portfolio was Alibaba, up 27%, although it's a small position. Microsoft up 19% as a major position. ICE up 14%, moderate position. Cintas up 12.8%. Amazon, my biggest position, up 11.9%. Thermo Fisher up 9.7%. Constellation Software 9.7%. Evolution AB, which is a casino gaming company, up 9.4%. Broadcom up 8%. Mercado Libre up 6.5%. The stocks that pulled down my portfolio in July is Pool Corporation because of higher interest rates. It got hit 15%, and also they missed on revenue and a soft guide for this financial year. Lind just announced earnings, so the stock dropped down 12.5%. Celsius down 11.9% because of growth derating, although there's no single verified catalyst for that. SOXX and ASML down 10 and 7% because of the rotation from the AI capex stocks to the non-AI stocks. Okay. So for July, what did I buy? I bought Meta. I added to Meta. I added to Netflix, I added to SOXX, I added to IPO, I added to HCA and AutoZone. No sales, if I recall, no sales for the month of July. Hi, so in part 2 and part 3 of the portfolio review video, I'll run through my capital gains stocks and update any changes in the intrinsic value or any changes in the support levels. So again, those of you who are new to UIP, every stock I would identify about 4 to 5 technical support levels below the intrinsic value. And these are levels where I would add shares if I don't yet have a full position. And I always add over 4 to 5 tranches. So as you guys know, recently there's been a lot of the earnings results coming out, and sometimes that changes the valuation of the stock if there's a change in the projected growth rate or change in the latest free cash flow or change in the latest net earnings. So altogether there are 7 stocks that we see an increase in intrinsic value. So to just let you know first before we run through that, United Health, increase in valuation, UNH, ASML, CrowdStrike, Fortinet, Alphabet, Google, and Microsoft, and ICE, Intercontinental Exchange. 2 stocks that have a reduction in intrinsic value. The first one is SPGI, S&P Global, because of the spin-off. They spun off one of the subsidiaries, so that slightly reduces the valuation of the parent company less the subsidiary, and a slight reduction in HCA Holdings. Okay, besides that, the rest, no change. So let's run through the 47 stocks and ETFs right now. And again, for ETFs, remember, there's no intrinsic value. For ETFs, I add simply based on technical support levels. So let's begin with Apple. Apple is a heavenly queen, and you can see it remains overvalued. Intrinsic value 251. And support levels 245, 228, 212, and 196. So I do have intention to add more to Apple, but I cannot because it is overvalued. Next, ACGL, also have intention to add more, but since I added, it went up and now it's above the support level. So ACGL above the support level. ACGL, the intrinsic value is 109. So it is undervalued, but it is slightly above the support level. So again, to be fully disciplined, I want it to drop near the support level, which is 97.26. Next support is 91.45, 88.44, and 85.88. For those of you who are new and you're wondering what this purple line is, this purple line represents my current average cost of the shares I've purchased. And of course, the green line represents the intrinsic value, and the black lines represent support levels where I would add if I don't have a full position. Next, AIPO ETF, support levels would be 29.81, 28.1, 27.04, 25.75. And as you guys know, I just added this because it retraced to the second support level, right? Went to the second support level. In fact, went to the third support level, but quickly bounced back up to the second support level. So I didn't have a chance to add at the third support because I was wondering if it could go to the fourth support, and then it jumped up. Yeah. Amazon just announced earnings, and again, earnings was good. Stock gapped up. So now it is above the intrinsic value, and it's my biggest holding. Intrinsic value 233. Support levels would be at 220. 199, 175, and 149. Next, ASML. So ASML change in intrinsic value. The intrinsic value was, 1193, and now it's increased to 1338. So quite a substantial increase in the intrinsic value, but it is still overvalued, as you can see. And support levels where I would add 1219, 1003, and $854. Next, we've got Broadcom. Now, ASML, I've got a full position, so I'm not adding more. If I didn't, I would add at the right level. Broadcom, I also have a full position, so I'm not looking to add. but if I didn't, I would add. Intrinsic value 422, it is undervalued and it just bounced off the first support, so slightly above the first support. Support levels 360, 326, 288 and 251. Next, AutoZone. So AutoZone is a predictable company, not high growth. The rest were all high growth, except, ACGL's insurance company, that's not high growth as well. So ACGL, AutoZone, they are predictable companies, not high growth, moderate growth. AutoZone intrinsic value 3714, currently undervalued and at a second support level. So I probably would add more next week when the market opens because I don't yet have a full position. So yeah, probably will add this next week. Support levels 3282, 3004, 2897 and 2730, just rounding off there. Next, Alibaba, my only China position. So I'm not looking to add to this position. And Alibaba, because they are spending a lot on building the AI infrastructure in China, positioning themselves as the main cloud provider there. So recently, their free cash flow has come down, the profits has come down. So I'm definitely not going to add. But even if they grow, I'm not going to add as well, because as those of you who have been around for a while know that I'm very weary of China stocks. Okay, so I'm just maintaining my small position. I'm not adding to it at all. Yeah. But the intrinsic value for Alibaba is 271. So it is very, very undervalued based on the intrinsic value where we use the normalized earnings and normalized free cash flow. Okay. Support levels 148, 141, 124, and $95. And as you can see, I am underwater, right? My average cost is 170, so this is below my cost. And I've been holding this for quite a while. One of those stocks that, well, what to do, right? Doesn't perform as well as you wanted to. Booking.com. Now, Booking.com is a great company. It's the biggest tour agent, travel online tour agent. And I bought it, as you can see, I bought it at $79 during COVID. And initially, I bought this as a proxy to the recovery of tourism from COVID. So since it recovered, I already sold about half my position. And I'm looking to sell the other half. Not because it's a bad company, it's a great company. The only reason I'm selling is because I already got 47 stocks, which is a lot. So I want to consolidate to less. And reason I'm selling it is because, like I said, the reason I bought it was the recovery from COVID, which it has recovered. Yeah. So I did sell already about half of it. And I'll probably sell the other half once it gets back near to its highs. It's currently slightly above intrinsic value, so I could sell it here. If I needed the cash, I would sell it here, but I don't really need the cash. So I'm going to just wait a while and see if I can get a better price. Okay, and then I will sell it, take the cash, and then reinvest in some of my other core positions. Okay, so no intention to add more to Booking.com. Intrinsic value 188, support levels 185, 165, 150, and 127. Now, Blackstone Secured Lending Fund, that is under the dividend portfolio. So I'm going to skip it and come back to it later on. Next, Celsius. So Celsius is a speculative growth stock. It's more risky, doesn't have the 5-year track record. So I bought it with the thesis of it's going to expand internationally and the growth is going to come from there. That's still on the cards, although its core brand Celsius has been decelerating. But Rockstar and Alani Nu, which they acquired, that has been giving them the current growth that they have. So I'm not adding more to this. I'm just going to hold my position and let's see if this turns out to be a winner or a dud. I don't know. Intrinsic value $40. Support levels 37, 32, and 27.64. Okay, maintaining a small position for Celsius. Next, Constellation Software. So this is one of our SaaS companies or software as a service that got hit by the fear that AI agents will disrupt and destroy their business model. But like I mentioned, for Constellation Software, for Viva Systems, and for ServiceNow, I think they're going to be the most resilient and be able to benefit from AI rather than be killed by AI. But because of the narrative, the fear, they have been hit and they are way below the intrinsic value. So I'm not adding to my position. I'm just maintaining my position for now. But I may add in the near future. All right, I may add maybe next year. But for this year, I don't have any more intention to add. So for Constellation Software, the base case valuation is 3837. Support levels 2926, 2573, 2232, 1919, and 1612. So you can see that it's significantly undervalued and it's right at the 4th support level. Yeah. So like I said, if I didn't have a position, yeah, I would possibly add here. Next, Copart. So Copart is an industrial company and facing a bit of a short-term cyclical slowdown in its growth. But I think it's cyclical, and long-term, the growth would resume and it should do very, very well. So I'm holding my position because I already got a full position, but I'm not adding more. All right. If I didn't have a position, yes, I would consider adding. Yeah. So also significantly undervalued. Intrinsic value 56, support levels 42.46, 37.40, 33.61, 29.54, and 26.09. Currently at the 3rd support level. Yeah. Next, we've got CrowdStrike, which is a speculative growth stock, very overvalued. I got a pretty small position. In fact, I only bought half my position that I wanted because the moment I bought it, it flew up and never came down. So it has already doubled from where I bought it. And now it's a 1% position, which is, it's okay, right? It's okay. But I would like to add more to it if it is able to come down. Intrinsic value increase from 93.76, increased to 101.8. Yeah, so right now it's still very overvalued. Support levels 93.40, 85.12, and 75.32. Next, Cintas. This is another industrial company which I was accumulating, and before I could buy enough, it shot up, and now I can't buy more until it comes back down. So holding my position, but my funds are ready to buy. Intrinsic value 174, which is also where the support level is, 168 and 161. Currently 204, price overvalued. Next, Descartes Group. This is another software company for shipping, logistics worldwide. And just like Constellation Software, it is now very undervalued because of the fear of AI agents disrupting their business model, which I don't think is the case. All right, it's more sentiment, not facts. Right, their actual results, the revenue profits have been doing very, very well. Okay, but I got full position, so I'm not adding. Intrinsic value 104, support levels 91.84, 79.25. 69.83, 61.13. Currently, it is consolidating at the 3rd support level. Next is Evolution AB. This is a Swedish company. So initially when I bought it, it's a high growth company, but the trouble was that about almost half of their business was from grey markets, unregulated markets for gambling, and they were making a lot of money there. And then they decided to go legit. We're going legit. And so they voluntarily withdrew from the, not black market, but the grey markets. And because of that, and they've now put in a lot of ring fences and all that. So because of that, their growth has slowed a lot and the stock price is now significantly undervalued, right? So it's, in a way, it's no longer a growth stock. It's now a moderately cyclical stock, but who knows, the growth may resume. So I'm still holding it because it's below my purchase price and it is doing okay. Right, they are growing and it's very undervalued. So I'm just holding it, but not adding to my position. Okay, unless I see the growth re-accelerate, then maybe I may add. Yeah, intrinsic value 119.9, support levels 86.64, 72.35, 65.87, and 56.59. Next, Fortinet. Fortinet has done very well. It's one of my 3 cybersecurity stocks. So increase in intrinsic value from 105 to 143. So quite big jump in intrinsic value, but still overvalued, right? New support levels 131, 109, 85. I already have a full position, so I'm not adding more. But of course, if I didn't, then I'll add if and when it drops to the support level. Next, Google. So Google announced earnings, which was very good, and the market dropped the price, which was a gift from the gods, as you can see. The price dropped after earnings. Right. And I always say that when a good company price drop after earnings, it's a gift from the gods. It's the time to buy, all right? But the trouble was it didn't drop enough. You can see it dropped, but it still didn't go below the intrinsic value. It was above the intrinsic value. And the intrinsic value at the time was 295. So now the new intrinsic value is 316, but it's still not undervalued, right? So yeah, but I already got a lot of it, and most of the subscribers and students bought a lot of it before already, yeah. So yeah, no, not looking to add any more of this. I'm trying to delete this. $295.57. Okay, so support levels at somewhere there. Okay, so support levels 295, 274, 255, and 235. Next is the China GXC ETF that tracks the Chinese companies on the Hong Kong exchange. I've got a small position and I don't intend to add any more to this. It is still underwater for me, as you can see. Support levels 97.13, 93.36, 89.68, and 85.11. Next, HCA Holdings, my biggest position under the defensive group. Slight reduction in intrinsic value from 445 to 423. Yeah, but it remains undervalued and below the first support level. So I got a full position, not adding more. Support levels 417, 387, and 356. Next, Intercontinental Exchange. I was adding to it, but it's gone up very fast, so I don't have a full position, but prepare to add if it comes back down again. Intrinsic value 172, support levels 162, 152, 143, and 124. So currently right at the second support level. So ICE is what I call a financial toll booth. It owns the New York Stock Exchange as well as many other futures and futures exchanges. Yeah. So whatever you buy, sell every day, ICE takes a cut, and your broker takes a cut, of course. Yeah. Next, IDEX Laboratories. This is a defensive stock. They produce diagnostic equipment for animals and for pets. And I only managed to buy very little, and it went up too fast, never got a chance to buy more. So that's why it's a small position. Intrinsic value 437 remains overvalued. Support levels 372, 318, 254, and 174. Okay, IHI, this is a medical devices ETF. I have a full position, so not looking to add more. But if I didn't, I would add. Yeah. Support levels 54.16, 52.07, 50.02, and 46.22. Okay, so the rest we will continue in the part 3 of the portfolio review video. On to part 3, let's finish off these stocks. So next we've got Lind PLC. So Lind is a company that makes industrial gases for manufacturing companies, even semiconductor fabs. They need industrial gas like oxygen and hydrogen. So bear in mind this is not natural gas, because natural gas, the prices are very volatile depending on geopolitics and all that, but because they manufacture their own gas, the prices are very stable, and so it's a very predictable kind of business, and that's why I love this business. I built a position. As you can see, my average price is 393 over here, and then it ran up so fast I didn't really get a chance to add more. So I really want to buy more, and now it's retracing down, giving me a chance to add to the position. So this is something that I'm going to add to probably next week. Intrinsic value 496.9, support levels 487, 465, 438, and 424. Now, bear in mind again, Lind is not a high growth company. It's a very predictable, moderately cyclical kind of business. Next, we have got LVMH. So this one is one where, when I bought it, it was, again, it's a great compounder, as you know, LVMH. But it has not done too well in terms of the share price for the last couple of years because of a combination of course, the war and the high inflation. So that has affected their business, especially in the Middle East and China. Their biggest market is China. So since the Chinese property crash, recession, and the Middle East war, all that has been keeping the stock down. But once that is resolved over time, then this would go back to new highs. Now, when that happens, I don't know. So just being patient, but I'm not adding more to this position. Reason I'm not adding more is I don't want too big a position in a company that is so sensitive to geopolitics. This particular company, all right? Whereas if you look at like a company like Microsoft, it's more immune from geopolitics, because no matter what happens in the Middle East and China, we still pay our Microsoft subscription. Okay, so intrinsic value 133.75, support levels 119, 114, and 103. So currently at the just bounced off the last support level. So no intention to add more to this. Next, MasterCard. So MasterCard and Visa are two of the financial toll booths. This one of the heavenly queens. I do have a full position, which I recently just added this year. So no more adding anymore. And you can see right now it's bounced back up, right? This was a great time to add. You can see wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, boom. All the way to support level 3. So it's adding here, and now it's wave up again. It will eventually wave all the way to a new high. So it's halfway on the wave up pattern. Intrinsic value 571. So currently it's fairly priced, no more underpriced. So the time to buy is over until the next wave down. Support levels 527, 500, 464, and 428. Next is MBG, Mobility Global. Now, this is a company that was in S&P Global. So think of it as S&P Global gave birth to this baby. All right, it's called a subsidiary which they spun off. So in a way, I got this free company. Well, it's not free. It was part of my S&P Global. And again, over time, obviously, I'm not going to add shares to this. It's a little baby, you know. I'm going to sell this, but only if I get a good price. So roughly my last valuation for this was about $32. Yeah, that's my valuation. So base case, pessimistic 25. So I'll only sell it if it gets to near 32 or above $32. So no hurry to sell it, because again, it's like free. I didn't pay for it. Got it as part of this spin-off. Yeah. Next, Mercado Libre. This is known as the Amazon of Latin America. So in Latin America, they are the biggest e-commerce player and one of the biggest fintech players. So long run, I'm very, very optimistic about this business. They're doing very well. Revenue, profits are compounding a lot. The only reason the share price has gone down is because the market is short-term focused. And they say, oh, because your profit margins have compressed, so we are not too happy. But the reason their profit margins compressed is because, number one, they're spending a lot on CapEx build-out, but not AI. They are building out their logistics and their fulfillment centers. At the same time, they are building their Mercado Mercado Pagi. I always get confused about all these words, right? But their fintech business, which is doing very well, their lending business. So because of that, you can't value it based on a discounted cash flow. Any company that's involved with banking, you got to use a discounted net income. All right, so that's what we did. And you can see it's quite undervalued. Intrinsic value 284, currently 1877. So undervalued. And it hit all the way to the last support level, as you can see. Now it's slowly waving back up, and it's right now at the second support level. So still within an attractive level. Support levels 2050, 1834, 1645, and 1481. I already have a full position, so I'm not adding more. If I didn't, I would want to add more to this guy. Okay. On the weekly time frame, you can see the 200 is a very strong support. Can you see that? The 200 moving average on weekly, right? Everything hits the 200, bounce, then hit the 50, hit the 50, hit the 50, hit the 100, hit the 200. Now it looks like it's going up after bouncing off the 200 moving average. Next, Meta. As you guys know, I've been adding to Meta. I've got a full position, but I'm adding a bit more, and I've got a little bit more I allocated to add. So Meta, intrinsic value 906, recently retraced down to the second support level. In fact, went to the third support level. Very briefly, didn't get a chance to add there, but I added right below the second support level. Support level 635, 580, 532, and 481. So the company is doing very well. And again, the only reason it has kind of like dropped and gone sideways is the market is short-term focused. They say, we don't like you spending so much on CapEx. But it is the spending on CapEx that will lead to more revenue growth, more free cash flow growth in the future. Yeah, so that's a good thing to me when a company invests in growth CapEx. And like I said, people are concerned, oh, their free cash flow has dropped and turned negative. Not just for Meta, but many of these hyperscalers, right? Am I concerned? Not at all. As long as revenue is growing and cash flow from operation is growing, okay? And the reason free cash flow dropped is not because revenue dropped, not because cash from operation dropped. Free cash flow dropped because their CapEx went up temporarily. And this CapEx is growth CapEx, not maintenance CapEx. Growth CapEx means they spend and invest on things that will lead to higher growth in the future, right? So in other words, it's totally within their control. If they want tomorrow, they can slash their growth CapEx. Their free cash flow can go very high if they want to, all right? So when a company does this on purpose, no worries, yeah? At least for me. I'm telling you how I think. Next, MSCI. So MSCI is one of the most predictable companies out there. And that's why it's always overvalued. Very hard to buy it undervalued. So I managed to buy, a bit here, and then it went off, right? And then since then, it's always been overvalued. So I'm like waiting there, waiting for it to come down, not coming down. So I've got a small position, but always cash ready to buy the day it goes down again. But normally it doesn't go down that often, yeah? So intrinsic value 491, overvalued, support levels 482, 457, 438, and 385. By the way, my voice is a bit hoarse. The reason is I was singing karaoke with my wife last night. Yeah. So got carried away with November Rain. Next, Microsoft. Microsoft and Meta are the heavenly queens. So again, Microsoft is one of those super heavenly queens. No close competition, no brainer, right? Intrinsic value increase from 559 to 570 remains very undervalued. You can see that it waved. You can see the 200 moving average is very strong, right? Here the 200, doing. This is hitting the 150, doing, 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 right? So this is a very strong support at the 200, which is the red line on the weekly candles, right? So recently it toyed again, so it's right now there. Still undervalued, but it toying back above the first support level, right? 431, 387, and 366 and 344. Next, MSI, Motorola Solutions. Yeah, for those of you who remember the Motorola phone, no, it's not the same company. Although, it was related once upon a time, but it's not the same company that makes mobile phones, okay? It's Motorola. They sell the mission-critical communications equipment and software command center for the military, for the police force, for the fire department, and for kind of like the emergency services. And within that niche, they are basically like a monopoly, okay, with very high switching costs. So very predictable company, and the great thing is got nothing to do with AI. It is totally non-AI related in terms of the CapEx build-up. But of course, they use AI in their software, right? Which benefits them a lot. So they are more like a beneficiary of AI and not a builder of AI. Okay. So if the AI bubble has a big collapse, this guy will benefit a lot. Yeah. All right. So and you can see it's been wave down, wave up, wave down. Now on the way to wave up. Okay. So intrinsic value 408, currently overvalued. currently a bit overvalued. Support levels 405, 388, and 358. Yeah. Next, Netflix. Yeah. No need to explain more. My wife would kill me if I ever cancel the subscription, and it's one of those subscriptions that for most people, you don't think about it, it just deducts every month you don't even think about it, right? And for most people, yeah, they're hooked to it. So it's a very predictable company. Used to be very high growth, and now the growth has slowed down, but they are still one of the leaders in streaming, of only second to YouTube, by the way, which we own through Google. Yeah, and Netflix has come down quite a bit. It's now and is now at the 200 moving average on weekly candles, just bounced off the third support level. So it remains undervalued, and that's why I've been adding to it. Yeah, intrinsic value 81.75. So it's not terribly undervalued because it's always been very overvalued, right? It is at least not overvalued. It is now slightly undervalued. Okay. Support levels 75, 67.75, and 58.76. I do have a full position yet. Let me just double check on that. Let's see. No, I still have a bit more to add, right? A bit more to add. About 1.52%, so a bit more to add to that position. Okay, next we've got Nike. Okay, yeah, one of the regrets I have, Nike. Yeah, so Nike is a long story. I won't tell the story again. I've told this many times, but Nike is a great business that got really screwed by their ex-CEO that really made bad management decisions, caused their growth to slow, and then right? But the new CEO, Elliot Hill, took over about 3 years ago, I think 2-3 years ago, and now he is doing his best to turn around the business, right? Changing everything. And it's working. You can begin to see Nike is back on the shelves again. They are now innovating new shoes, but it's taking longer than expected, okay? And will Nike be able to reverse and go back to all-time highs? I think there's a good chance, but I'll probably put the chance at 70-80%, right? Or maybe 70% chance. So I'm not adding to this for two reasons. Number one, it has not yet turned around actually. Yeah. So their revenue and profits are still dropping. So, okay, if I wanted to add, I'll wait for it to stabilize and grow again. I need to see that grow again. But I'm not going to add even if that happens, because one of the things that I realized, and actually I knew it, but I kind of like didn't follow that my own advice, right, is to stay away from fashion retail stocks. Because it's very competitive, like Lululemon. You know, I was very lucky because I bought Lululemon and I managed to sell it at a very nice profit before it collapsed. I was like, okay. But now looking back, yeah, I shouldn't have bought Lululemon. But, you know, luckily I made a lot of money from it. And Nike. So the thing about fashion retail stocks is that it's very competitive and consumer trends change very fast. So I learned my lesson, stay away from consumer retail stocks. But since I'm in this and then I've got a very small position, you know, no point selling now. I could sell it and then reinvest in something else, but it's like such a small position and it's quite undervalued. And Elliot Hill is slowly turning things around. So I'm going to just give him another few more quarters, okay? Next, ServiceNow. So ServiceNow is one of those other software companies that got hit by the fear of AI killing them. But to me, ServiceNow is one of the stronger ones. And they just demonstrated it. They just announced their earnings. Earnings was great. Their revenue up, billings up. So the stock price drop is so far purely emotional, not grounded in facts, because the facts are doing very well. So I've got a full position, not adding to it, holding my position, and it's above my cost anyway. Yeah. So intrinsic value 204 remains quite undervalued at a half price. Support levels 135, 121, 105, and 80.82. So currently it is right at the third support level. Next, we've got Nvidia, one of the other heavenly queens. So I've got a full position in Nvidia. If I didn't have a full position, yep, I would add now. Why? Because it just waved up, waved down to the first support level at 190. Okay. Intrinsic value 221, support levels 190, 153, 130, and $90. So first support level, slightly undervalued. for NVIDIA. You can see my average cost is about $60, right? I first started buying at $15, by the way, right? $15 was my first entry, and then as it went up, I kept buying more, and so my average is now $60. Novo Nordisk. Okay, so those of you who are new to UIP, I tell you a bit of history, right? Since the beginning of time, since 20 years ago to 21 years ago, when I've been teaching this class, I told people, stay away from drug companies. Don't buy drug companies. Don't buy pharmaceutical companies. They're very unpredictable. And then Novo Nordisk got so cheap, and at the time they had like 70% market share of the obesity and weight loss market. I said, I'm gonna buy it. So I broke my rule and I bought this drug company. And then since then, they lost their market share from 80% market share, dropped to 40% because Eli Lilly, their main competitor, caught up. Because they didn't innovate as fast as Eli Lilly, right? So that's why I've got a big drop in the share price. It's below my cost price, one of my boo-boos in life. And of course, I could sell it, but again, I'm not selling it for the same reasons as Nike. It's a very small position, and their recent oral weight loss pill is doing very well. So that is now beating Eli Lilly. So that is like the Hail Mary, okay? So they are growing, all right? It's not that they're not growing, they're growing. They are very undervalued, but in the long run, I'm not going to hold it because they are still a one-trick pony in terms of their obesity, diabetes medication, whereas Eli Lilly has a much broader portfolio of drugs, okay? So once it gets near the intrinsic value, above it, I'm going to sell it, and I'm not going to buy Eli Lilly because, again, that's like breaking my rule twice, to stay away from drug companies. Too unpredictable. Once they fail a drug trial or phase 2 or phase 3, it drops a lot. Recently, they failed one of the drug trials, but it is not their main obesity drug. It was a, I think, cardiovascular drug, which was a small bet, right? So, again, it dropped, about 9%, was it yet, on Friday? Yeah, drop here. So this is more emotional, right? It's not really, doesn't really change the valuation. It was more of an emotional drop. So I expect that to recover quite fast anyway. So holding it for now, but no intention to add to this guy. Yeah, intrinsic value 72.96, support level 67.59, 56.59, 45.62, and 34.95. Next, Palo Alto, one of our heavenly queens. Why? Long run, cybersecurity will just keep growing. You need cybersecurity. Once a company uses cybersecurity, they are stuck. They can't switch vendors very easily. So it's one of those great, very predictable, very, very high growth companies. And I've got 3 of them: Palo Alto, Fortinet, and CrowdStrike, right? So Palo Alto is the leader among the 3, and Fortinet, CrowdStrike, very close as well. Now it's very overvalued. You can see I was accumulating here, right? I bought here. So my average price is 153. Right now it's like, oh, okay. So now cannot buy anymore because it's overvalued. Got to wait for it to drop again to buy again. I don't know when that's going to happen, but it will always happen, yeah? So be patient. Don't chase the girl. Girl run away, don't chase. Don't lao nua, chase. Okay. You chase, the girl slap you, you fall back to earth, right? Wait for the girl to run into your arms. Wait for her to get scared and run to you. Be patient, yeah? So support levels 198, 165, and 142. PBDC, that's in a dividend portfolio, so we'll cover that in the next video. Palantir. So this Palantir is started as a speculative growth stock. Technically, it still is because it's not had 5 years of consistent growth of profits yet, but it will, yeah. So it's kind of like somewhere in the middle between speculative growth and large growth, right? My average price is $9, as you can see, right? Bought it long ago, and I've already sold 70% of it. My last sale was 160, I think 170, right? Because at the time I was very overvalued, so I sold it. But in fact, when I sold it at 160, it was kind of like 150% overvalued, because the intrinsic value was $80 at the time. But since then, their recent earnings report showed that their profit and cash flow went up so much that the revaluation is now worth about 143. So that's the new intrinsic value. So based on the new intrinsic value, it is no longer super expensive. It is slightly undervalued, right? But I'm yet to add it back, what I sold, all right? And I don't really have to because I already have quite a big position in Palantir. So I'm just going to hold it. I'm not going to add to it for now, yeah? We'll see how it goes, yeah? Intrinsic value 143, support levels 142, 125, and 105. Currently at the second support level. Pool Corporation. Now, historically, Pool is a great business, okay? It's a very, very consistent long-term compounder. Okay, long-term compounder. Let me just show you the very long-term chart. Yeah, as you can see, right? Very, very consistent long-term compounder. And about so they are the biggest wholesale pool manufacturer and maintenance company, swimming pools in the US, okay, and Canada. And 60 to 70% of their business is recurring business, because once you buy a pool, you got to maintain the pool, buy chemicals and maintenance equipment, right? 70% is that, and that continues to do very well, okay? But 30 to 40% of their business is pool construction, and that depends on how the housing market is doing. So for years, the housing market has done well, except of course during the global financial crisis. And when the housing market does well, people buy new houses, they renovate their house, they put swimming pools, they do very well. Now, what happened here? What happened here is because the Fed raised interest rates in 2022. And of course, the long-term 10-year interest rate, a treasury bond, has gone up. That caused mortgage rates to go up. And what happens when mortgage rates are high? People buy less houses, right? People don't take loans to renovate their house. And because of that, new pool construction is at an all-time low, and that's why you've got this. Now, if you think it is cyclical, that eventually the housing market will recover, mortgage rates will go down eventually, of course not right away, then people start building pools again, this would eventually go back up. So this is a long-term kind of recovery process, right? So I've got a fairly okay position. I'm not adding more to it. I'm just holding my position. Yeah. So that's a bit of backstory for Pool Corporation. PTY dividend stock. Let's skip that. SHL. This is a global X defense ETF. So this ETF holds a lot of the military defense companies, both the legacy companies like Lockheed Martin, Raytheon, General Dynamics, that makes all the the traditional fighter jets and warships and all those things. But they also own a lot of the next generation drone warfare companies. And it's not just US, they also own a lot of UK military things. So if you believe that wars will continue and governments like the UK will spend more and more to beef up their military because the US is not going to protect them anymore, then this is a lot of runway, right? So I have half, I think 3/4 of a position, gonna look to build until I've got a full position to this one. So I may add more next week, right? Support level 68.15, 64.61, 60.47, and 58.03. Okay. Now, because I know quite a number of you are new to UIP, who just joined, that's why I'm spending more time explaining each company. But I don't do this every month, right? Because normally every month I run through this a lot faster. Just spending more time because we've got a lot of new subscribers recently. Next, SOXX. This is the semiconductor ETF. And one of the best performers because of the AI CapEx build out. Okay. And I already sold about 30% of it somewhere here, right? I already sold, I think I sold about 30% of my shares, 25 to 30%, something like that, right? Why? Because now this ETF contains the things I own, right? So it already contains Nvidia, it contains ASML, it contains Broadcom, which I own individually, right? And those to me are not expensive, yeah? But it also contains things like Intel and AMD and Micron, and those others, which to me the moats are not that strong in the long run. And some of them are a bit overvalued, and that's why I kind of like sold 20 to 30%. Since then, it has come down, and I started nibbling back again a little bit. But I won't buy back the 30%. Maybe I may buy back 5%. That's it, right? I don't want to be too overexposed to the entire semiconductor industry. Although I think that the AI capex build out can last another 1.5 years, but I don't want to be overexposed to one industry. Okay, I don't want to be like Leopold. Okay, support levels 489, 436, 369, and 322. Next, S&P Global, another heavenly queen. So S&P Global, they own the S&P brand. So anywhere in the world, whichever ETF benchmarks against the S&P 500 or the Dow Jones, they take a cut. Every time a company issues bonds, they need to rate the bonds. They rate the bonds. They take a cut. So you can't escape from that. It's a financial toll booth in the global financial world. So intrinsic value reduced from 520 to 510. Why? Because they recently spun off the mobility company, right? So slight reduction. Remains undervalued near the last support level. So I've got a bit more to add. I'll probably add more next week. Support levels 480, 457, 429, and 400. Next, Thermo Fisher, heavenly queen as well. So they are the leader in medical, healthcare, accessories, equipment around the world. Okay, so they have been consolidating ever since their boom during COVID. Right, they become like going sideways since COVID. But once it breaks out of this, it should be very, very strong, right? So in the meantime, while it's consolidating, I've been buying near the support levels here, right? Right now it's wave up already. So intrinsic value 619, support levels 528, 501, 458, and 414. Now bear in mind, it's a heavenly queen. It's not high growth. It's not a high growth company. It's a very defensive, recession-proof company, right? Healthcare. They provide all the medical equipment and like test tubes and stuff like that. United Health is the leader in managed healthcare in the US, leader in health insurance and managed care facilities. So my average price is $323. I bought it when it plunged because of short-term bad news. One of the CEOs got murdered, if you guys remember, and they got cyber security attack, right? So a lot of bad news that hits them in the short term, but long run, their economic mode is not affected. So these are the kind of companies that I like to buy. Hit by short-term bad news, but the long-term business model remains very, very strong. So recently they announced great earnings and the intrinsic value has increased from 412 to 437. So remains slightly undervalued, and right now it's pulled back to the first support level. Support levels 409, 384, 356. Next, Visa, which is together with MasterCard. They are a duopoly in the payment technology world. Visa now overvalued. Okay, same as MasterCard. So this was a great time to buy. As you can see, it waved down to near the last support. Here, wave down again to third support. So we wait for wave down, we add, wave down, we add. Now wave up, we don't chase the girl, we wait, right? So everything has its seasons. Intrinsic value 335, support levels 325, 308, and 292. Okay, Viva Technologies or Viva Systems is the other software company. They specialize in the life sciences. They provide cloud computing and customer relationship management to the life sciences industry. So it's very niche, very strong mode, very high switching cost. It's like a Salesforce, except niche to the healthcare industry. Yeah, intrinsic value 270, support levels 217, 201, 169, and 150. So currently it is now waving up to the second support level. No intention to add more to my software positions. Okay, finally, waste management. Waste Management is one of the most predictable defensive companies. Not high growth, moderate growth, right? And it's in my heavenly queen. Heavenly queen, yeah? Now, I don't yet have a full position, but I'm going to add more when it reaches the second and third support level. My average cost is 211, by the way. So intrinsic value 230.98, support levels 222, 213, and 197. Okay, so there we go. That's a review for all 47 stocks ETFs in the capital gains portfolio. In the last two parts, I'll cover my dividend income portfolio, which is totally separate.